Hello traders, welcome to another global macro update. In this video, we're going to talk about the statistics of the US economy and also just going over some fundamental news involving the COVID spread and virus and kind of the second wave that could come into fruition. And obviously, that would be pretty bearish in terms of the outlook for the economy and the prosperity of really the American people, because we're mainly looking at the S&P for our trade that we're going to be looking at. So first off, let's jump right into some of the statistics here of the United States. First off, let's look at initial claims. This is the unemployment claims. As we can see, we are still soaring. 2008 looks like an absolute blip. .com boom, we can see right here, absolute blip. And this is the continued claims. So this was the initial claims. So this is brand new, fresh, unemployed individuals, whereas this is the continued claims of the insured for the unemployed. And we can see it is climbing yet again. So it's not like it's just a one-time fee. They are continuing to receive the unemployment insurance because they can't find a job. For every single waiter, waitress, bartender, any real entertainment, unless the economy opens up, you're not going to be able to receive a paycheck. So you're going to be dependent on the government to provide for you until that happens. And that's what we're seeing right now, is it's not just a one-time payment. It's a continued reoccurring payment that needs to be paid to many, many millions of individuals in the United States in order for them to sustain their living conditions, pay for food, rent, cell phone, and all that stuff. And then these two are a weekly frequency in terms of the updated data, and then this unemployment level is going to be the monthly level. We can, unemployment levels are always going to be lagging indicators. They're not going to be forward-looking, but we can see that it did spike for the month of March. This is a monthly reoccurring chart, so it only is going to come out with new data every month, and we can see March was a huge jump from 5,700 all the way to 71. So we'll see how April looks. Obviously, we're on midway through on the 14th, so we'll see how the next month is looking. But yeah, as we can see, in my personal opinion, I just don't understand how people think that the bottom is in terms of looking at the severity of the impacts within the job markets and how many individuals are actually getting affected by this, and then looking at the chain reaction. If you think just about mortgages, rents, we're only really 2 months into this. Imagine if it's 3, 4. Then, if you're missing 3, 4 payments, that really stacks up against you. So at the end of the day, I feel like it's going to get worse before it gets better, and no one likes hearing that. But just in terms of in my opinion, just a basic understanding of comparisons, this is definitely worse than 2008. And we have analysts from, Goldman Sachs, even the Fed, saying that this is going to be a lot more drawn out than people think. So now let's go to the man himself, Neel Kashkari, the head of the Federal Reserve Bank of Minneapolis. So he said in his own words, bearing some healthcare miracle, basically, other than that, it's looking like an 18-month strategy of rolling shutdowns based on what happens in other countries. 18 months, right? It's not going to be an instant startup of the economy. It's not like you can just turn on and off the economy like a light switch. There are long-lasting impacts that are going to kind of ripple throughout the economy. If one person doesn't get paid, one man's spending is another man's income, and when you kind of just turn off taps of the entire economy in a sense, that's going to have some long drawn out implications. And we can see we could have these waves of flare-ups and controls until we actually get therapy or a vaccine, he said. And we'll touch on that very shortly. The last thing that we're going to touch on before we move on to the next one, looking at the different countries who are already seeing these flare-ups. Looking ahead, Kashkari doesn't envision a quick rebound for the U.S. economy, which has already suffered more than 16 million job losses in the past 3 weeks. That's an unbelievable number, really. So for those who think that, the stock market's going to rebound super quick, the only buyer is the stimulus package. The stock buybacks obviously are not really happening anymore, and there's 16 million people who now have no income. In my personal belief, I just don't understand why so many people are bullish. A lot of misleading analysts going on TV, talking heads, talking about the reasons why we're going to have a V-shaped recovery, talking about 2018, talking about 2015. We'll go over that within the charts, but yeah, those recoveries definitely ingrained in a lot of perma bulls' minds and a lot of MMT theory, Keynesian economic individuals, that the dip is always going to be a buy. Always buy the dip, and that's what a lot of people are kind of putting out there. And in my opinion, that's just really setting a lot of people up for some devastating losses. Now, I do believe that you should always do your own due diligence. Don't just look at one trader, one analyst, one resource and say this is the end all be all. Always do your proper due diligence. Look at multiple sources. Think critically. Think for yourself, and that's the best way to go about being an independent thinker, in my personal view. So now getting into the waves, we can see it's already happened. Singapore, Taiwan, and Hong Kong, who were very aggressive in their actions taken to try to curb the spread of the virus. They're witnessing fresh waves of coronavirus infections as a growing number of cases around the world test their successful early defense against the disease. So yeah, like many people have been saying this as well, is it's not going to be a one-time wave where we're going to get a huge impact and it's all going to just go away and there's not going to be another wave. It's going to go in cycles where each wave is probably going to get smaller, but there are still going to be new cases that emerge in the third wave, fourth wave, fifth wave, whatever the case may be, and I think it will inevitably fade out, but I don't expect this to be a one and done sort of deal. There are going to be reemerges of this virus, unfortunately, but that's just from my perspective. This is how it's going to play out, which would obviously be bearish for the stock market. I just don't see how, stimulus packages and infinite money printing will prop up the stock market for infinity, because there's no real buyers other than this brand new, freshly printed money. And that's just a base of confidence. That's what it is. We'll see how it goes. We have our TA. We're going to base our trades off of our technical trading analysis. We're not going to be looking at the news. We're not going to be looking at any fundamental factors that directly make us enter or exit a trade. We're going to be looking at the chart. That is going to be our bias, because price action is, in my opinion, a more reliable source of information rather than the talking heads at CNBC. Or if you're just looking at economic data, obviously that is up to interpretation, but that's going to be better than, in my opinion, looking at what an analyst says from Goldman Sachs, or looking what an analyst says from wherever. Just looking at the data yourself and coming to your own conclusions is, my opinion, a better way than getting an opinion from someone else. Obviously, you're watching this video, and it's good to get other people's opinions. I do as well, but for your critical thinking bias that you're actually going to be risking money on, you really want to be making sure that you're trying your very best to come up with your own conclusion, and you're not just going off of what this random person says. Like, you shouldn't look to short this market if you're not actually wanting to short because I'm short. You should do it because of your own thesis and your own bias. All right, so that's a little bit of fundamental factors coming into play. Let's now go into the S&P 500 during the 1930s. So this was, I don't have a trading view chart. I really wish I had candlesticks, and then we can see the extremities of the wicks and the volatility, and it'd be a lot better. But unfortunately, I don't have a chart that dates back all the way to the Great Depression that I have on trading view. But what I did do is sort of recreate the chart, I guess, in a line form, just doing the key highs and lows, so then we can put our Fibonacci retracement levels, looking at where the retracements hit, and then understanding how that could how we could use that information to try to extrapolate some system to use in our current trading. So we'll put this this just aside for now, and I think we're going to go to it right now because obviously this is the topic at hand and it's going to be right here. So I know it looks a little bit messy. Let's just go like this. And I'm just changing the distance. There we go. All right, so let's get our snip and let's just talk about how I drew this structure right here. So let's make this, it's pretty hard to see black and white. So basically we have the top right here, which is 473, which actually let's make it black because it's actually red would be easier to see for everyone. So 473, that's right here. So 473. So that's 473 up here. And then we have the low, which is right here, which is 312. So that's 312. Oops, 312. And then up here is going to be 378. 378. And then we have a dip, a little pullback, and then a push down. A dip, a little pullback, and then a push down. And this is 245. This is 245. So I hope you're understanding where it is. And then this is 294 right there. All right. So I'm going to just change that 4 because that looks really gross. 245. There we go. Okay, so you kind of understand the structure of the market in terms of the highs and lows, the swing highs and the swing lows. And now we're going to overlay the projection that we have within the structure here. So this is the first push that we saw, in my opinion. This guy right here. And this is going to be the strong push from 473 to 312. That retracement only went to the 38.2, the 382 level, right? So that what this means is from the low, it only went 38.2% up to the high. And then it came back down, and then it saw weakness from the buyers. Sellers came in, took over control, took over confidence, and pushed the price down. Now, 382 is a key level within the Fibonacci retracement levels, but what we're ideally looking for to create more confluence within our current structure is that 50% to 61.8% retracement level. These are these two zones, in my opinion, are going to be the supply zones that we're wanting to look for weakness within the buyers. And we'll get that within the later video, but that's our first retracement level in the Great Depression. We got a massive push to the downside. Our first retracement was only to the 382 level, 38.2 level. And then we got another dump down, right? So then let's take all this out. So this was the first move. This was the first correction. And then what do? We look for that next push to the downside, right? So then it hit that 382. Did not go to the 50% or the 61.8. But, you know, that is telling us something, and then it pushed to the downside. What is our next move? We're looking for the next correction. Now, what I did do is, there's two highs here. If we look at, let's just take away all this and start from fresh. If we look at the two recent highs, which is going to be from here to here or here, so let's call that A, and let's call this B. If we do the fib retracement from A to the bottom, let's call this C. So if we do the fib retracement from A, which is all the way up here, to C, it's going to hit, yet again, the 38.2 level, this high right here. And then we make a market structure to the downside. So 2 times we're hitting the 38.2 on the in the Great Depression, at the start of the Great Depression, basically. But if we actually put the anchor point, the swing high at B, so instead of it right here, you are actually putting the swing high here, we can see that it's right in between the 50% and the 61.8% fib level. Now, obviously, fib retracements are somewhat up to interpretation. It's not like you're putting a RSI or a MACD on the chart and every single person is going to have that exact same number. Fib Fibonacci retracements are up to interpretation. You are deciding where you're putting your highs and lows. Unlike, for example, an RSI, you just type in RSI as an indicator. If you're looking at the daily chart, you're basically going to get you are going to get the exact same number as the person next to you. Whereas if you're going to ask someone to use a Fibonacci, that will be up to interpretation. Are you going to go up to the wicks? Are you going to go just to the bodies? Which time frame are you going to use? There's a bunch of variables that is going to matter for using Fibonacci retracements. So, it is up to interpretation. So instead of putting the major high up here, but we put it a little bit lower, it's still a major swing high, as we can see on the line chart. We have the pushes and impulses. You have a push, impulse, a push, impulse, a push, and let's bring it down, and then an impulse. So from here to here, the retracement was right in between 50% and 61.8, which is exactly what we backtested in 2001 and 2008, and came out to be a successful, profitable system that should yield profitable results in this current recession, in my personal view. Obviously, this is not financial advice. Obviously, this is not something that you should be just doing randomly. You have to understand the risks, understand how to manage a trade, how to set a trade plan, how to navigate within whatever brokerage or exchange you're using. There's a lot of information that you have to know before just entering exit trades, but at the end of the day, it's looking like our thesis of the 50% to 61.8% fib retracement is still valid back all the way in the Great Depression. Obviously, it's pretty hard to tell just with a line chart. It'd be much better using candles, because then we can go to the daily chart, look at the candle closures. We have a lot more of a specific criteria and a specific way we actually use the fibs, but obviously with no data for the candlesticks, we have to go to the line chart, and basically that's the analysis that we got. We didn't continue to do more plots within the chart, but just looking at the retracements, there are a lot, because of the aggression of the stock market crash back in the Great Depression, a lot of the retracements only actually made it to the 382. So instead of the 50% or the 61.8, it only made it to the 382, meaning that there's actually in a very strong level of supply or bear pressure to actually not even get it up to the 50% range. But with our current stimulus packages and a lot of kind of market manipulation really from the Fed, we are seeing a bounce that's hitting the 50% fib level. And we can see this is the current market structure right now on the 4-hour time frame. We have a nice ascending wedge formation here, and we have hit and surpassed the 50% fib level, which is around the $2,800 zone for the SPX. We're still making higher highs and higher lows. There is no way that we're looking to short just yet, obviously. We need to see our price action pattern break, confirm us that we are now going to enter short, and we have not seen that yet at all. We'll also go into the 2015-2016 market crashes, the real quick meltdowns, and then a huge surge in buy pressure, really rewarding the buy the dip mentality, even in 2018. So we'll talk about that right now. Let's actually use this chart instead. So let's go auto. All right, and then we can see right here, these are just the fib retracements. So 50% is just under the $2,800 mark, and then the 61.8 is going to be around the $2,950, and this is on the SPX. So talking about basically getting rewarded for buying the dip, the biggest dip of all in recent history was 2018. Look at this massive sell-off that occurred, right? And look at that V-shaped recovery. We got a huge sell-off, but basically in the same amount of time, we got a recovery that pushed the price up to the all-time high and even broke it. 2019 was a phenomenal year, especially Q1 of 2019 was a phenomenal year for the stock market, and we can see they got rewarded for buying the dip. Same as the start of 2018, massive push to the downside here, but yet again we got a rally. When it dipped again, we got another rally. So we've been seeing these buy the dip mentality. Perma bulls get rewarded time and time again. And then back in 2015, 2016, we got some huge corrections here. September 2014 was kind of the initiation where we got a dip of almost 10%, but recovered almost faster than the actual move down. And then we see the same thing back in August of 2015, a huge 11% move down. We got a double bottom and then pushed it right back up, yet again rewarding the buy the dip mentality. Exact same situation we saw back in August of 2015 happened in January of 2016, a huge dip down over 11%, 12%. We got a double bottom and then a recovery, pushing all the way up to the recent highs, and then it just kept on climbing. Every dip gets bought up, and then we just see the continuation of the move up. So when people say buying the dip is always a good idea, it makes sense why they think that, because when does a crazy market crash happen? Like every 8-10 years, right? 2001, 2008 were the most recent, and between that, basically almost every single dip is getting bought up and hitting all-time highs and breaking all-time highs. So why is this one going to be any different for a lot of people? It's not, and that's why you're seeing this huge buy the dip mentality. But because it's still the first move down, I still think there's a lot of hope for people, and the US hasn't really hit its second wave. It's still dealing with the first wave, like we talked about. Singapore, Taiwan, Hong Kong are all facing their second wave of COVID, and it's going to be third wave, fourth wave, fifth wave. It's not going to be a one and done, in my personal opinion. So understanding that, my bias still has not changed. I have the exact same bias that we've had for a very long time, which is bearish. And we can see, let's talk about the S&P in a little bit greater detail when we zoom in. Let's get our snip. This is the 4-hour chart of the S&P 500. Let's get our white marker. So we have a nice ascending wedge here. And I did just draw in our mid-range zone within the wedge. That's just kind of separating the higher part and lower half of the wedge. But at the end of the day, we're looking at this key level of resistance and this key level of support. Now, there's two options in my personal view that this is going to go down. Option one is once we get this pullback, we're just going to go and break down the 2200 and continue further down until we hit our extension, which is the 272, which is going to be around, let's zoom out, let's say 1900, right? And then if we zoom out, 1900 is a pretty well-respected zone throughout the chart. 1900, let's go here and then look at 1900. It's where the bottoms, like we talked about back in 2015, 2016, they got bought up. So let's go to the weekly chart and then discuss the 272 extension that we currently see. This is going to be our first take profit for the short that we are going to be putting in once we have validation. Let's get our rectangle. And we already talked about the dips, right? In 2014, 2015, 2016, all these dips here, the double bottom, we've talked about these in the video today. Now, if we just extend this support zone out, where do we see it extend to? Really perfectly, the 272 extension of our fib, right? So what we're looking for is we're wanting to get failure for the buyers and confidence in the sellers around the 50% retracement. And what we're wanting to do is hold until the 272. Until then, after that point, we don't exactly know. And then we're looking for our second correction, right, of the C1, C2 formation, like we talked about within the previous market structures. So in my view, everything is still coming into play. There's nothing really that I need to do as of right now. There's no real actionable things for me to do other than to patiently sit and wait for this to come to me. I'm not going to rush into it. I'm not going to enter short. So some people were asking me, why don't you just enter short right now if you're so confident and have so much conviction that your 50 to 61.8% retracement is going to hold? Why don't you just enter right away? The reason is I don't know if it's not a guarantee. I don't know, right? So at the end of the day, I'm only going to enter on the highest confirmation setups, which means I only am going to enter if I have A, this hold, this supply zone hold. B, I got a confirmation that this ascending wedge is breaking to the downside, which means that the three pillars we're looking for, two primarily, one VSA we don't really use as much within the S&P, but what we're primarily looking for is we're going to be looking for market structure, making a series of lower lows and lower highs, also looking at the price action pattern of this ascending wedge. Once those two things check off pretty well, for me, that's going to be my short. And I'm not going to try to complicate the entry, beyond belief. It's not too difficult in terms of the actual entry specifications that I'm looking for. But that's how I'm going to be looking at the market. If it does, like, let's say the Fed somehow prints so much money that it just works, right? They get a recovery that they're looking for. The price would break this ascending zone, and I wouldn't enter short. If it continues going up, I just wouldn't enter a short. Simple as that. I need confirmation. That is going to be the number one thing I'm looking for, right? So at the end of the day, you need confirmation. It's not, if it hits a certain price level, I'm going to enter. Basically, when you're trading, you are going to be the follower and the market is the leader. It's like a dance. When you're dancing, I don't really know what kind of dance. I'm not a dancer or anything. But when you're dancing, there's a leader and a follower. As a trader, you are never the leader. I'm never going to tell the market, you are going to go to 2,900 and then you're going to drop. That's not how it works. The market needs to tell me, man, the buyers are really weak. The sellers are coming in. They're gaining more confidence. The buyers are losing confidence, right? The story needs to be present. The opportunity needs to be there before I make the trade, and that's what I'm waiting for. Every weekday, I'll be patient. I'll wait until the opportunity comes. If it doesn't come to me, I won't enter. But basically, at the end of the day, what we're looking for is a good, solid, high probability situation to enter, and if it doesn't bring it to us, we're not going to take action. We're traders. We're not looking to hold our bias forever. We need to be flexible. We need to be nimble, and we need to be able to change our bias if need be. But if the market hasn't given any indications that it's changed, your bias shouldn't change. And mine hasn't either. Since that first move, I've been waiting for the correction. And it's finally come in. I've been, even at the lows here, I said, you're just waiting for crumbs at this point. It makes sense to wait for that first C1 correction 1, right? That is what we're looking for. Once that comes into play, then we have another opportunity on our hands. But anyways, that is going to be the analysis for the S&P 500. We took a little bit of a outlook on the 1930s stock market crash of the Great Depression. We noticed that a lot of the corrections were only getting to the 38.2 level, not even at the 50%, which is just showing the aggression of the sellers at that time. But right now, we're seeing the 50% hit. But in 2001 and 2008, both the major corrections during those stock market crashes hit at least 50% or the 61.8 fib level, indicating that there's a high probability that we're going to have that same thing happen. And that's what we're going to be basically trading. All right, so that's going to be the S&P 500. Now let's just quickly talk about the US dollar index, DXY. Now, looking back at the daily, we saw a massive surge in volume here with gold, silver, equities across the board all selling off. Some people might not know, if you're trading equities, you're trading a pair. Every pair that's on the American stock exchanges is paired with the US dollar. Same as every ounce of gold, silver, oil. The US dollar is a world reserve currency. So when people are selling off assets, commodities, US equities, they're buying the US dollar. And we see a surge in that right now. So then if we are underlying our macro picture of the US stock market with the US dollar index, what are we potentially going to be seeing next? Well, if we are expecting another sell-off within the S&P 500, what does that mean? If people are going to be selling stocks, they're going to be buying the US dollar, right? So if our thesis is all going to be playing out in front of our eyes in the way that we're expecting, we're probably going to have another surge in the US dollar. Now, this is why I'm a little bit worried about investing in gold, trading gold at the moment. We did break our key structural level of 1700 as a resistance, so that's great to see. We'll talk about that a little bit later. But at this point in time, if we are taking our S&P 500 analysis and then projecting that bias onto the FX markets, the US dollar, in my opinion, should see another surge in growth, because when people are selling equities, commodities, they're going to be buying the US dollar. And let's just jump into the 4-hour here. We have a nice descending zone. I don't really want to put in any real squeeze yet. The only real level of support that I currently see is a horizontal zone, which is going to be right around here. Let's say it's at 98.25-ish. Let's just zoom out a little bit further to see if I can locate a nice zone. Yeah, I'd say around 98.40, 98.35 would be a potential level of support, but at the end of the day, we're not really going to see this move up until we start seeing that shift happen, in my personal opinion. All right, excuse me, I'm going to get a little bit of coffee, and then we'll continue on with this analysis. All right. Like I said, if you have any questions, just definitely drop them in the comment section below, and we'll be sure to answer any of them. So we did S&P 500, we did the dollar index, made that relationship, made that correlation, and then we're now going to go into gold and silver. I'll just keep that within right there. All right. So let's talk about gold first, and then let's jump right into silver. Actually, mind that. We're actually going to look at the gold and silver ratio first, because this is pretty important. If you don't know what this is the gold and silver ratio. You can find it on TradingView just by typing gold silver, and then you'll find it. What this represents is for 1 ounce of gold, you get almost 110 ounces of silver. Now, this is representing an extremely undervalued silver for decades. This chart dates back to 1997, but even through decades and decades and decades, this is a very undervalued time for silver. Now, understanding that, we've talked about this blow-off top very often within our Discord. Let's quickly look to see if we can find it here. We do have a large amount of people talking, but we do see it right here. Okay, so let's first look at the commodities and talk about ascending wedge squeezes, blow-off tops we call them. So this is our first blow-off top. We also see another blow-off top within the equities, within the S&P. This is another blow-off top where we see an ascending wedge with a resistance and an ascending support. We get a break of the resistance, we get a fake blow-off top, and you get a massive bearish move to the downside, breaking the zone of confluence where the two trend lines are intersecting. Once that is broken, you have a high probability in a continuation to the downside, because a lot of confidence is lost. You have two trend lines that are both significant, that both got broken. In my opinion, that's pretty bearish. So that's the first one, and then we're going to also look at another blow-off top, which was in the altcoin markets, which is right here. This is XRP. We see this another ascending wedge with a blow-off top breaking the resistance. We see that the price hit a nearby level of resistance, and there was a little squeeze that occurred here. Once we broke down below both trend lines, we got a little ascending channel, and we got another massive move to the downside. In my opinion, this looks very bearish. I think we're going to get a next leg down, but you can kind of see the structure that I like to view ascending wedges. In my opinion, yeah, they could be bullish, but at the end of the day, they're a lot more bearish in my view, and they often have a blow-off top here that is going to entice a lot of inexperienced traders, a lot of traders who are letting the emotions get the best of them, because they're extrapolating what they saw in the past, saying, wow, the past month, this asset has been really going up in price. It's probably going to continue. Now, this is some pretty dangerous words here, because just because a price or an asset has been going up doesn't mean it will continue to go up. And this last little push here, in my opinion, is kind of the end hurrah before reality hits. And in my opinion, this is kind of the same thing that's happening with the gold and silver ratio. We're getting our one last hurrah where silver is extremely undervalued, and we're probably going to have some huge move when there is more speculation coming into the precious metals sector, because right now I don't think that global investors are worried about inflation. Look at the CPI numbers around the world. CPI is Consumer Price Index. It's going to be the inflation, the percentage of the cost of goods and services for like an average basket of goods or whatever. It's basically going to be counting inflation, understanding, trying to analyze inflation. And this is done in different economies, so you can see not just in the United States, but different countries in the world. How is the inflation affecting them? Is there deflation, inflation? Deflation means that the goods and services are going down, which would not be very good for gold and silver, because gold and silver are safe haven assets. They are going to be looked at if there's any sort of inflation because of the fixed supply characteristics that they share. In that said, right now, let's look at the smaller time frame for gold and silver. We can see that it is looking like it's holding here on the 4-hour chart, which doesn't look great. What this is kind of showing me, at least to me, is we could have another attempt here, because when we get these massive exaggerated moves, most likely we can test that zone yet again, because it's not very far. We see that the lows are getting less low, and we see right now we're holding a series of higher lows, which is a little bit more bullish. But you know, this has two meanings. Either gold is going to remain relatively stable and silver is going to go down, or gold and silver both are going to go down a little bit more, and silver is just going to get a more beating and a further drop than gold. But as of right now, I don't really have any trades for gold and silver. I'm not going to want to be entering just yet. I know we just broke 1700. That was a very significant break within gold, but looking at just this ascending zone right here, we can see first anchor point. Let's get our favorites. We see this point right here connected to this point right here. We got our third point right here. So in my personal view, yes, it's still a resistance. A decent situation for us to enter would be possibly right here. Let's get that green. And why is that? Well, first off, I like to enter on retests, personally. Just my personal opinion, doesn't mean that it's right or wrong, but I personally like to enter at the completion of the exhaustion phase. So in markets, there's going to be impulse phases that are going to go up or down. There's going to be impulse phases, and there's going to be corrective phases. What we're wanting to do is enter at the completion of the exhaustion phase. So right now, we just completed the impulse, or we're in the impulse phase still, because we just broke a major key zone of 1700. What we're looking for the highest probability situation, in my view, would be to enter at the completion of the pullback, validating the previous resistances as a new level of support. If that's the case, well, then we have a horizontal level of support that we can depend on for a nice demand zone, and then we have a nice little area for a potential first take profit if you are looking to scalp, or if it's more of a longer term hold. Obviously, that would be a good possible entry to extend all the way up to our next key level of supply. But in my view, too early to tell on gold, too early to enter, just my personal opinion. I am super bullish on gold in terms of where it lies in the global macro aspect of things, but just looking at the charts, I would like to see a little pullback. It's made a strong push to the upside. I think entering now would be a little FOMO, and you know, I think there is a better opportunity when we do see that nice pullback and then we see the price hold. That would be a really good opportunity in my personal view. Also, looking at the daily chart, I don't know if you can really see it, but there is a nice reverse head and shoulders, and let's just get our snip. So this is the breakout zone 1700, and we can see this is the left shoulder, this is the right shoulder, and this is the head. Let's just draw it in right here. We see your left shoulder, head, right shoulder, breakout, pullback, and then an extension. In my view, that is a pretty good structure that we're going to be looking for gold, but we're looking for that pullback. I don't see it yet, and that, in my opinion, would be the best opportunity that I would be able to find for gold. So right now, we're not really looking for any opportunities. I think, like I said it before, being patient and waiting for that pullback would probably be a good opportunity to give you, in my opinion, a good situation to get a solid risk-reward trade in your hands. All right, now let's go to silver. Silver has been, in my view, more of a bearish opportunity, and I'll tell you exactly why. I've said this before, gold, when you're looking at the weekly time frame, what do you notice? Or even the monthly, right? But let's just look at the weekly, take off all of our stuff. What do you see when you just zoom out and look at the weekly? You're seeing clear higher lows and higher highs. We did hold that $1,400 level, but overall you're seeing just within like 10 years or whatever, you're seeing higher lows come into the market, which is more bullish. So then it makes sense to look for more long opportunities. Now, understand that, and then let's look at silver. Let's take all that off. Let's look at the weekly. What do you see on the weekly? Zooming out, right? You're seeing lower highs. So on the gold chart, you're seeing a horizontal resistance. On silver, you're seeing a horizontal support. On gold, you're seeing higher lows pushing the price up. On silver, you're seeing lower highs pushing your price down. So this is why I'm going to have a different bias on gold and silver on the short term, right? There's a lot of volatility. There's a lot of uncertainty. Gold and silver are obviously correlated. They're both precious metals. They're both instruments that investors and traders use to try to store wealth in times of uncertainty, and silver is going to be the more speculative, more volatile instrument that investors use. So right now, because there's not a whole lot of speculation within the commodities market right now, because there's not a surge in the demand for safe haven assets, true safe haven assets like gold and silver, I don't think that the US dollar is a safe haven asset. They can just literally print as much as they fucking want with it. That's not, how is that a safe haven asset? But basically, we're not seeing global investors run for fixed supply assets yet. I think they will, but right now we're not seeing that demand, and that's why, in my opinion, silver is not performing as well as a lot of individuals are wanting it to do. But in that said, I think that silver will outperform gold in terms of price appreciation when there is that momentum starting to shift. But right now, I'm still not super certain that I want to be long silver. I'd rather much be longer gold. I don't mind that at all because it does look pretty good. I already talked about the possible pullback to around the $1,700 zone, and the next major level of supply is going to be just under 1,800. So we got a lot of space here. 1,700 to 1,800 is a pretty solid trade. And that's going to be what we're going to be looking for gold. But silver, in my opinion, just does not look bullish enough on the weekly chart. I'd like to see the price break a major key zone. $16 is a structural zone that we can see. Let's just take some stuff off. $16 is a structural zone that we're still under, that in my opinion would be a really key zone for us to pass. But I just don't want to, in my opinion, be too bullish on the whole precious metal sector right now because there's a lot of uncertainty and there's no real inflation coming into the market. And also looking back at 2008, gold didn't really see any price appreciation until almost the end of the 2008 financial crisis. We didn't really see, there was a lot of chop, there was a lot of consolidation, there was a lot of noise. We saw a series of major lower lows and lower highs, and it was only until the end of the 2008 financial crisis that we actually saw the huge parabolic gains that gold was able to provide investors. So, you can't extrapolate everything that happens in the past, but it does make sense that during these turbulent and uncertain times, there's going to be a lot of deflation, there's going to be a lot of panicking, a lot of emotions that are going to be taking place that's going to drive markets to kind of do random stuff that we're kind of seeing right now. So that's my analysis for silver. Like I said before, I don't really have a trade for silver or gold right now, and that's perfectly all right. As a trader, you don't need to be trading every single day. You don't need to be trading, and you don't need to have a trade plan and a trade on for, let's say, gold, silver, or any other instrument at all times. That would be absolute stupidity if you thought that. You gotta wait for the good setups, especially in these uncertain, volatile times when there's so much happening, there's so much news coming out, and it's a lot of work keeping up with all the news, but I absolutely love it. It's super exciting, but to keep it short, gold and silver, I don't really have an analysis for anyone, for any major actionable items other than the gold analysis that we did, but that's a pretty simple one. And the main trade that we're going off of is going to be the S&P 500 trade that we have on our hands. Potentially. Doesn't mean that it's going to come through, but as of now, that's basically the main trade that we're going to be trying to really capture. So obviously, huge market. We kind of stuck our necks out, really just telling everyone, going on a weekly, daily video, telling people, updates about our idea, our thesis, how it's going, and yeah, we'll see how it goes, right? We have a system, we have a thesis, and we're going to take action when we need to, and we're going to sit and wait and be patient until that moment occurs. So that is the end of the global macro update. We will answer all questions on TikTok as well as YouTube, but the recording will end now. This will be posted on the YouTube. If you haven't checked out our YouTube, we post weekly videos, or like every weekday, every workday when the markets are open, we post a video describing our analysis on the cryptocurrency market, looking at Bitcoin and a bunch of alts, as well as global macro, looking at currencies, indexes, commodities, and just trying to grasp what is happening. It's crazy world out there, a lot of stuff occurring, but as a trader, this is an extremely, extremely interesting, weirdly exciting time if you're a trader, but obviously it's not exciting if you are on the other end of it. But yeah, everyone keep their heads up, everyone stay in a positive attitude, and I wish everyone the best. So I'm going to close off this recording, and then I'll answer all the questions on TikTok. So for everyone watching this on YouTube, thank you very much, and until next time, happy trading.